Welcome. I'm Catherine Magana here with Steve Wolf, Gregg Carroll, and Rachel Ivanovich, where we're here to provide you insights about the markets and planning and much more. So it's been quite the week as we reflect from last week to this week. Today is May 8th, and as of yesterday's close, which was May 7th, the Dow Jones was actually down as of yesterday 3.36%. Which was about
for the
year to date, and that doesn't include today because today the markets are up. But from last week to this week, there was about a 1% move. The NASDAQ between last week and this week, there was about a 1.5% move, and as of yesterday's close, it was down 8.14. And then the S&P 500 was down as of yesterday's close 4.26. But today the markets are really kind of moving forward, and I mean anything can happen between now and the close, but so far it's looking like we're having a strong day in the market. Yesterday the Fed came out and didn't change rates, which was expected, but I think we're still kind of waiting to see.
Well, I think the big news today was the UK agreement, the trade deal. And these are the things that we've been waiting for.
Yes.
And kind of get an idea of where we're at. And, it doesn't look like the 10% tariff for imports is going to go away. But certainly the deals are better than what we had been talking about.
And then I think everyone's been anxiously waiting for China and the U.S. to kind of come to some agreements and seeing what that looks like. So.
Yeah, I heard. I read something on the way back from my appointment. Is like Trump is telling people to buy before we get the China deal done, because you see what it's doing with the UK deal. So who knows?
Is that insider trading?
Right, I know. Right?
He's pumping and dumping. He's probably selling. I don't know. It's but that just seems I don't know, odd. We'll say odd that he would say something like that.
I don't know. Every day's a new day.
He might come up with a new. He might bump China's higher before the end of the day. So who knows?
The interesting thing to me is the CNN Fear and Greed Index is now up to 62, which is in greed territory. And just 2 weeks ago, it was at extreme fear.
Wow.
So
I think the sentiment has definitely changed in the last couple of weeks.
But I think this is somewhat of a lesson. That I hope that everyone who's listening to this takes away, is that when everybody is at their most fearful, that is the time you should be licking your chops to buy things. Yeah. And when everyone is at their most exuberant, you probably, if anything, if you're not going to hold, you probably should be selling. So when we do just the opposite, most people, that's human emotion.
Well, here's one of good indication of how divided our country is. Talking about consumer confidence, the Democrats are at 34.5, and Republicans are at 90.2.
90.2?
90.2. The Democrats think we're going to have about 6.5%, 7% inflation over the next year, and Republicans think it's just fine where we're at.
Again, that's why you got to put your political feelings aside when you're
100%.
talking about the markets.
Yeah, it's, the one side listens to this newscast and this one listens to that.
We've said this before, but it was just the opposite when Biden was in office.
Totally.
The Democrats were, I don't know what the exact total was, but they were probably about 90% in favor, and the Republicans were at the 30%.
Selective hearing.
And the market went up, and the market goes up no matter who's been president.
Right.
And I know, there's never been a president like Trump. Well, maybe so, but, I look at all the different crises we've had. We've never had different crises like some of them we've had. It's always something different. Yeah. It acts the same.
It always feels bad when you're in it.
It feels terrible. And I don't even know if we're out of this yet.
No.
Right. Trump could come out with something else, and all of a sudden the market falls by 10%.
So it was interesting. I was looking at missing out on the best days and how it can be costly. So this was from Fidelity and Bloomberg as of December 31st of 2024. So if you had $10,000 and invested in the S&P 500 on January 1st, 1988 through December 31st of 2024, if you were fully invested, you would have approximately $522,576. If you missed the best 5 days, you would have $330,060. And if you missed the best 10 days, you'd have $239,410. So once again, for those that say, "Oh, let's jump in, let's jump out," or "I'm worried," and it's really hard to try and get out. And then when do you get back in? And these markets move very, very quickly, and so that's
that works the other way too, though.
Yeah.
If you miss the worst days, then you've done well. The problem is you're never going to get that. Mm-hmm. If you try to time the markets, you are never going to get over a consistent time frame the high points and the low points. It just doesn't happen. Even if you're the luckiest guesser in the world, you're not going to get it.
I think a lot of those happen very close to each other, especially those big down days, the washout days. You get those rebounds, and the people that panic sell, emotionally sell, they do that on those big down days, and the up days are right behind it, very close most of the time. So, you got to ride through that. Don't sell when people are panicking.
It's so hard to not do anything when your emotions are running wild.
Right.
When you see the lion running at you, and and you're saying, "I think I should move," as opposed to stay here. Right? It's the fight or flight that is.
Or freeze.
I think I'd run.
The reality is doing nothing is also a decision too.
Yes.
So that's
Correct.
part of it. Even though you feel like I have to do something, if you do nothing, that is doing something. You're not doing anything to change.
If you do something, that's doing nothing.
Yes.
We're getting deep now.
But it's part of it. Fight, flight, or freeze.
Yes.
Yeah.
That's the third one. People
Right.
forget about that.
But for the most part, it's been very, very rare indeed that getting out of the market has been the right thing to do. Mm-hmm. Okay, sometimes, if there's a company that's not doing well, okay, sell it and make yourself feel a little bit better. But to get out of the entire market, and we've had people who've come in here recently who at the lows, got out. And, they were asking us, well, aren't you afraid? And our answer was no. And they would look shocked. And first of all, what good does being afraid do? All it does is cloud your judgment. And the reason we say no is because we don't know if it's going to get lower, but we know that past history tells us that if you're just patient, the markets do come back. Now, let's hope that, we've seen the lows. It looks like it. It looks like we're finally starting to get some deals done. Here's a prediction. Let's see if it comes true. There's no way that we're going to get all these countries done within the 90-day time frame that they talked about. Right. So I think if there's a few that happened, I'm going to bet that Trump says, you know what, we're going to delay because we're talking to a lot of countries and we're getting ahead of things.
I like it.
I'll bet that happens. And eventually you're going to get a deal with China. It may not be the greatest deal in the world, although Trump will say that it is. This is a huge deal, a great deal,
Best deal ever.
Beautiful deal. But it will happen. And the markets will then get back to fundamentals. And I have a feeling, too, that if it does start slowing down, that regardless of what Trump has said about Powell, I think Powell will eventually, who's the Fed chairman, will eventually start lowering rates. So I think there's a lot of things that could happen on the positive side. You just got to be patient.
So it looks like mortgage rates are holding steady the last couple weeks. It's at about 6.76% right now. Once again, we're not at the 2.5%, 3%, but I think 6.76 seems pretty reasonable based on if you're buying a new home or moving.
Although we sure like to get those rates down.
Yes.
And the government wants to get the rates down because of the amount of debt service that we're paying. So to them, I have a feeling that's also one of the things in Trump's mind that says, Powell should be lowering rates because we're paying, if I'm correct, and I think I am here, we are paying more in debt service than anything else.
Yep, almost $1 trillion.
So we've got to get rid of the debt, and certainly would help if the interest rates were lower.
Yep. And then looking at one-year CDs and one-year Treasuries, they're pretty comparable right now. Their one-year CDs is about a little over 4%, 4.005, and then the U.S. Treasuries for 1 year is 4.039, which it changes daily, but it's held pretty steady, a little over 4 over the last few weeks.
So what's going on in the tax world?
A lot of people are talking about moving, selling their house and moving. I've had multiple meetings the last, 10 days pretty much, where people are saying, well, I'm considering moving out of California. And so they want to know about the tax implications of selling their primary residence and what should they do to plan for. And honestly, there's three stages in home ownership that you have to consider. It's, when you buy the house, you need to make sure that you're keeping the closing paperwork from that, at least in a digital format, so that when you do sell the house, you have that available, because there's recording fees, there are title fees, there are legal fees that you actually can write off. And people, maybe you bought the house 20, 30 years ago, you want to make sure that, because that house is appreciated a lot, you want to make sure that you have every write-off that you can. And then the second stage is really when you own the house, making sure that you're keeping track of any remodels that you do or any improvements that you make to the property. If you do make any landscaping improvements, but if you're just painting, that's not necessarily going to count. But you want to make sure if you put on new roof, new siding, that you're keeping track of that. Because people want to know, can I write this off every year when they come do their taxes? And I would say, no, keep track of it, though, for when you do sell the house. And so there is some confusion with the capital gains exclusion for the sale of primary residence. I have a lot of people who come in and say, well, I'm just going to take the proceeds and I'm going to dump it into a new house. Well, unfortunately, that was some outdated tax legislation. The Taxpayer Relief Act of 1997 changed that. So literally, and I think they honestly, in the tax community, we've been talking about this for a while, because for years and years, almost 28 years almost, it's been $250,000 per spouse or per individual. So if you sell your primary residence and you've lived in it for 2 out of the past 5 years, you can exclude up to $250,000. Now for California, houses have gone up dramatically, and so that doesn't even really touch these capital gains that people are seeing. And I had a client who was really upset yesterday afternoon, where they were like, "We can't even use the money out of my house," and I said, "Well, you're able to exclude $500,000."
But you're only paying tax on the rest. You still
Correct.
get to keep 80%.
You get to, yes, exactly. And then when you sell, so that's kind of the third stage of owning the house, when you buy, and then when you own, and then when you sell. Realtor fees and any other closing costs, title charges, and so on, you can write those off as well. So people will always say, well, I owe this much on the house, and I bought it. They usually don't think about what they bought it for. I owe this much, and this is how much I'm selling it for. So if you're thinking of moving out of state and or just selling the house and either downsizing or buying something else, and I know that a lot of people have been holding on to their interest rate because they love that. Maybe they don't love their house, but they don't want to necessarily sell the house and get a higher rate. But I'm seeing a lot of Californians say, I'm moving out of state, I'm going to dump all that cash into a new house. So you need what you're selling it for, less what the closing costs are, subtract off the purchase price, subtract off the improvements, and then subtract off whatever your exclusion is, the $250 if you're single and $500 if you're married.
That exclusion's only on the federal tax, though, right?
It also applies for California
It
and
does.
most of the other states. I can't think of one state that it doesn't conform.
I was under the assumption California didn't allow that.
It does allow, California
good.
does allow that, thank goodness. But when you do sell, whatever the difference is between your gain and that exclusion, so let's just say you have $200,000 after you subtract off your exclusion, you pay tax federal, state, and then the federal level, if your income is over a certain level, you'd pay the net investment income tax
I
as
say
well.
between that plus the
almost
long-term
50%.
capital gain plus state taxes, I mean, you really have to
You also
account
need your
for that.
passport to get out of California.
You do.
Real ID.
Yes.
Real ID.
Real ID, exactly. So plan ahead. There are certain things you can do. I mean, I talked to the client yesterday who was upset, and I said, well, if you have any losses in your portfolio, you can sell those losses and you can use those to offset any gains from the sale of your
I say,
house.
and this is why we don't have the conversation before.
Yeah.
You can, but sometimes we have to go after.
Exactly. But because there are some planning moves that you can make.
So I was reading something that said that the Trump administration is talking about not lowering the capital gains, but raising the income level for the certain brackets. Have you heard much about that?
I have heard a little bit about it, but I'm not going to count my tax brackets until they hatch. So
Okay,
we'll
well,
see.
well, I think we can at least talk about what they are doing.
What they're
Or what they're
proposing.
proposing. They're proposing to raise the amount of income that you have
To stay within
to stay within the certain
15% versus the 20.
So they're talking about maybe instead of 500,000, I think at the 15 to be in the 15% capital gains rate. I think they're talking about going up to like around 650.
Yeah, I heard that as well. But again,
You
wouldn't-
don't think it's going to happen?
I just don't like to consider that law until it is actually law, just because they
You should
changed
work for Powell.
They just
On the one
they
hand,
just changed their mind so many times. I think it would be great if they did it. I actually think it would be great if they increased the exclusion for sale of a primary
I'd
residence.
say it seems a little outdated. With
Well, it's been the same number. It hasn't been indexed for inflation at all in the last 28 years.
wow.
I'd actually like it if they would do away with capital gains, because really what they're doing is they've taxed you on all that money, and then you make money on it and they tax you again.
Absolutely.
Of course, the people who are receiving it are saying, yeah, but we need that money, and it's in the last, I don't know how many years, 15, 20, 30 years, the people who are paying it is increasingly narrower and narrower and narrower, where the top 5 or 10% are paying the vast majority of all the taxes.
Well, I was, one of the other clients I was talking with, I mean, for them, they really hadn't saved much for retirement. They had their home, and that was it. And it had $2 million worth of equity in it. And now, turn around, they have to sell it. They're moving out of state because they could afford to live more comfortably in another state, but they're going to pay almost $300,000 in capital gains tax.
It still leaves them $1.7 million.
That's great. And all, however,
Maybe about 1.6.
But that's their only money, and so they're paying $300,000 that could have been invested, and then they could be living on the interest.
But there are other places, like a place where I lived in Kansas, where you could probably buy a very, very nice house for $300,000, $400,000,
Yes.
maybe $500,000.
That's true.
And now you still have $1 million something left, which is why
1.5.
people are moving.
Absolutely.
And this is all self-inflicted in this state. It really stems. It is. It stems from terrible, terrible government policies, and yet we keep electing the same people. And I know I will get arguments on that, and I know that there are people who think that these are the greatest things in the world, but you can't keep taking money away from the people who make it. They can move.
Yes. Well, one of the other things I suggested, and this is a tax planning piece, is they could, instead of selling the house right away before they actually try out the new state, because I was like, well, how do you know that you like Tennessee or, fill in the blank? And I said, well, you could rent the house out. You still have that 2 out of 5 years, so you could rent the house for 3 years and still qualify for the exclusion. If you rent the house out and you rent somewhere else at a lower cost, then you could 1031 the house. I mean, there's ways around it. So
1031 exchange.
So 1031 exchange is basically what you can do with a rental property. You can't do it with a primary residence, but with and they call it a like kind exchange. So you can exchange a rental home for another rental home, and you basically defer the gains. But then once you've had the rental on the other side, you rent it, and then you rent it, and then you can move into it, and the gains still stay deferred. And if you live in it till you pass away, when your children inherit it, the gains go away. So even better.
So how long do you have to rent it out to consider it a rental?
They like 2 years,
Oh, okay.
but it doesn't necessarily have to be 2 years.
A little
If-
grayish.
There's a gray area there, yes.
All right.
So one more thing before we wrap up. The IRS came out for 2025 for QCDs, which is a
yeah.
qualified charitable
was
distribution,
exciting.
reporting that they are now, there's certain boxes where it can be indicated if it was a charitable distribution. A qualified charitable distribution is you're eligible if you're over 70 and a half from your IRA or simple, or if you're no longer have an active SEP IRA. But what happens is usually we see clients take qualified charitable distributions when they have to take the required minimum distributions, which is now age 73. And so in the past, the custodians would report just a 1099-R. And now going forward, there's going to be a box where they
It's
can
so
you can
great
indicate.
because as advisors, we have no idea if it's a qualified charitable distribution or not unless the client tells us.
But at the end of the day, it's still a responsibility of the
The tax-
client
taxpayer.
and then let the tax advisor know, because, and also when you get that 1099-R, make sure you double check it.
That it's correct.
So just something
They're
that's
often
kind of
wrong.
it is a big change, and I think it's important, especially like you mentioned, when you're dealing with taxes and you see that 1099-R and you have no idea that they made that charitable distribution.
You have to ask, and they should tell you, but sometimes they forget.
Yeah.
And they have to do that before they take the rest of the required minimum distribution, correct?
There's some
Yes and no. Yes and no.
Really? Okay.
So, in essence, The money just can't go directly. So, for instance, as a client, they can't take the money into their own bank account and then give it to the charity and say, oh, that was a qualified charitable distribution. It has to go from whoever the custodian is directly to the charity.
And that can happen in any order, though. Is what you're
Yes.
saying.
So I've had clients take money out and then but if, let's just say they only take a tiny bit out, and their RMD or the required minimum distribution is much larger, and then they say, well, I want the rest of my required minimum to go to this charity instead of go to me. So, but for instance, if they've taken it already, they've taken $10,000 and their required minimum is 12, they can't turn around and say, oh, I want the whole 12 to go, because they've already taken possession of the money.
Gotcha.
I'm curious, on a percentage basis, how many of your clients do you think do these QCDs?
About 10%.
Okay.
It's not a huge number, but I don't have a lot of retired individuals yet, because most of my clients have kind of grown up with me. And so when I started my practice, they were all in their 20s and 30s. And now everybody's thinking about retiring. So
My clients started with me when they were in their 20s and 30s too. And they've grown up with me, and now we're in our 40s.
And now you're taking your
Yes.
QCDs, your RMDs. Just kidding.
Of course, I think more people would do charitable charitable donations if there was like a one-to-one tax
absolutely.
deduction.
Yes. If it was like a credit versus a deduction.
Sure.
I'm sorry, you're right, as a credit.
I think
So
it's
that would
great.
come directly off of
your
the tax
tax.
that they owe.
I
Versus
think
off
we've
the
seen a
taxable
shift
income.
over the last few years. I
Yeah.
feel like they may not do the whole requirement
But they do a
distribution, but they
portion.
do a small.
I think a lot of people didn't even know
know
that
that,
it was a
yeah.
possibility. And so I think just getting the word out that you can do this.
Right. But again, you have to be charitably minded, and
Yeah.
to do this.
Yes.
A lot of people can't afford to do that, but for the people who can, it's a nice little.
I think it's great. And I think the charities like it too.
Well, of course, and that's my point. I think the charities would get more money if we
Absolutely.
would say to people, okay, this is a one-to-one
Dollar
credit
for
off
dollar
of
reduction of tax.
right, and then it would maybe have a little less dependent on government and being able to collect a lot more tax.
I think people would love that because they would say, I really want this money to go to build this wing of the hospital, and they could give it to a particular nonprofit organization.
Right, and then the money can go to actually where you would like it. I think that's part of a lot of people's angst about giving taxes to the
Yes.
government. It's because it's so inefficient, and it doesn't get to the places where you might want to put it. So
Hear that from clients.
I'm sure you do. I'm sure you do.
I wouldn't mind paying taxes if I knew if it went where I want it to go.
Yeah, self-directed.
Well, a lot of people do say that. It would. Hey, maybe here's another idea. If the government is listening, I'm sure they are.
Where's your phone?
Why not have something on your tax return that says, okay, I'm paying this amount of taxes, but I want it to go to X, Y, and Z. Obviously, you're going to have a certain amount that has to go to some places, but beyond that.
Yeah.
So, it's a new idea.
It's like it's a whole new
Great
tax
idea,
system.
I
Alrighty.
Well, I think the whole tax system
I
stinks. So,
I do too.
remember when they said they were going to put it all on a postcard? We should be able to put, was
I think
that
that
Trump
was
who said that?
Yeah, that was 2020, 2018. There was one year where the signature was right in the middle and that was the postcard that he had created, or whoever it was created it, and it was just the weirdest tax return ever. Anyway, they simplified it by adding 6 schedules.
From how many?
0.
Well,
So they
they
had
didn't.
So there was the 1040, and they were like, okay, here's the postcard. But if you have anything that's more complicated than this, you have to attach one of 6 or all 6 schedules to it. So,
Do you know that the income tax was voluntary in the
I
very
do.
beginning?
1913,
I think
right?
it was 1913. It was voluntary.
Yes.
Doesn't seem to be voluntary anymore
Nope, they made it mandatory during the war,
during World War II, and then they never cut back
and
on
it
it.
just kept. Yeah.
But it was never, ratified by Congress or something? Because there are organizations out there that still, to this day, will tell people, it's voluntary. And
Yeah. Good luck with that.
I've known somebody that tried that, and then they had to go make up those taxes. Eventually had to pay it.
That's why the IRS is in existence.
Exactly.
They're going to come and knock at your
They call
door.
it-
And I think IRS is the most feared government department of any of them.
Oh, I'll tell you, people.
I was
they
telling
are
the guy,
scared
how do
they're
you
going to go to jail. You know why they call it the IRS? It's theirs.
It's theirs.
Yes, it's not your money, it's theirs.
Theirs.
I like that. All right, well, let's see what happens with the market here. We're starting to get it. We've got the first deal. Let's see if we get some more trade deals, see what it looks like. But I think there's a little bit of a template here going on. And if it's what we see here, I don't think it's going to be monumentally bad the way people thought. I still don't like tariffs. All it really is a tax. But again, I think that Trump says, I want to use that 10% tax to help pay for our deficit. I can understand why he wants to, but it will hurt a little bit in the economy. It will slow it down a little bit until we all get, kind of equalized.
And then once we kind of get some of these trade deals in place, then we'll be looking at tax reform, deregulation
Hopefully
potentially.
before
So
December.
there could be much better news on the horizon once we get this tariff.
Well, let's hope so, because
Deal
I
in
can
the-
tell you that April was a really, really rough month for not just because of the stock market, just because people's emotions.
Oh, yeah.
I mean, I've never seen, so many, well, I shouldn't say I've never seen, but there were so many people who were just depressed at what was going on. So hopefully that will change. All right. Well, we'll be back next week for another exciting adventure of the tariff tourism,
Tax.
whatever it is. And by the way, the tariffs, has anyone heard, has that hurt tourism at all yet?
It has, the tariffs haven't, but our perception around the world, Europeans are down like 20% traveling to California right now. Mexico, double digits. Canada, I think, is high single digits. So the international community is not traveling here as much.
It's interesting.
Not the tariffs, but just everything we're doing about it.
What about the U.S. Citizens going elsewhere? Do you know if that's changed
I
yet?
have not heard if we are slowing down going anywhere, but I did talk to some friends that just came back from Europe, and I asked them, so any
How is it?
animosity out there? And they're like, no, not really. It's,
As long as you show up with the money, they're
yeah,
fine.
if you're buying their stuff, are they going to complain about that?
All right. All right. Well, thanks again for listening. We will see you next week.
Thanks.
Thank you.
Bye-bye.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.